welcome you to the press briefing for the 119th Monetary Policy Committee meetings, which took place this week. At the meetings, the committee deliberated on recent global and domestic macroeconomic developments and assessed the balance of risks to the outlook for inflation and growth. A summary of the assessments and key considerations that informed the committee's decision on the positioning of the monetary policy rate is as follows. Global growth outturn was better than expected in the first quarter of 2024. The stronger than expected growth outturn was driven largely by improvements in the services sector in the euro area, as well as increased consumer spending and policy support in China, which offset the continued weaknesses in the property sector. However, headwinds such as the depleting stocks of accumulated pandemic-era savings, the gradual cooling off of labor markets in advanced economies, and rising uncertainty related to elections in many countries this year may weigh on growth prospects in the second half of 2024. Consequently, the latest IMF World Economic Outlook growth projections remain unchanged at 3.2% for 2024 and 3.3% in 2025. The tight global financing conditions has persisted, underpinned by a cautious approach to rate cuts in advanced countries. The tight monetary policy stance by central banks in advanced economies has broadly led to higher long-term bond yields and triggered exchange rate pressures in emerging markets and developing economies. This has reinforced a cautious approach to policy rate cuts. Notwithstanding the tight policy stance, the strong growth in the first quarter of 2024, coupled with the dovish tone of the U.S. Federal Reserve, has boosted equity markets. Global headline inflation remains on a downward trajectory, although the disinflation process is expected to slow. The decline in headline inflation in several countries observed in the first half of the year was on the back of the sustained tight monetary policy stance by most central banks and broadly anchored inflation expectations. In the outlook, strong nominal wage growth, which may de-anchor inflation expectations in the short term, is expected to pose some risks to the disinflation process. On the domestic front, provisional GDP growth pointed to a strong growth recovery. The latest release by the Ghana Statistical Service showed real GDP growth at 4.7% in the first quarter of 2024, higher than the 3.1% recorded in the same period of 2023. Beyond the first quarter, the bank's high-frequency real sector indicators reflected a pickup in economic activity, evidenced by the updated Real Composite Index of Economic Activity's annual growth of 3.3% in May 2024, compared to a contraction of 3.7% in May 2023. The key drivers of the growth in the CIEA were private sector contributions to SNIT, imports, cement sales, exports, domestic VAT, and tourist arrivals. The latest confidence surveys indicated some softening of consumer and business sentiments. These findings were broadly in line with observed trends in Ghana's Purchasing Managers Index, PMI, which fell below the 50 benchmark to 49.7 in June 2024 from 51.6 in the previous month. Recent price developments suggest a resumption of the disinflation process. In June 2024, headline inflation eased to 22.8% from 23.1% and 25% in April. The decline in headline inflation was attributed to deceleration in non-food inflation by 2 percentage points to 21.6% in June. Food inflation, on the other hand, increased by 1.4 percentage points to 24% over the same period. In line with the ease in headline inflation, the bank's main core inflation measure, which excludes energy and utility items from the consumer basket, declined to 22.1% in June 2024 from 22.6% in May. Fiscal operations in the first half of the year were broadly aligned within the set targets. Provisional data on budget execution indicated an overall fiscal deficit on commitment basis of 2% of GDP against the budget target of 2.7% of GDP. The deficit of 21.3 billion Ghana cedis was financed from both domestic and foreign sources. The primary balance recorded a deficit of 2.3 billion Ghana cedis, that is 0.2% of GDP, against the deficit target of 2.4 billion Ghana cedis, or 0.2% of GDP. Growth in broad money supply moderated in the first half of the year. Annual growth in broad money supply, M2+, slowed to 34.2% in June relative to 44.4% in June 2023. The slowdown was reflected in all the components, that is, demand deposits, savings and time deposits, and foreign currency deposits. Reserve money, however, recorded an annual growth of 77.8% in June 2024, compared to 29.2% in June 2023. The growth in reserve money was due to the adjustment in the reserve requirements of banks. Private sector credit extension steadily improved in the first half of the year. In nominal terms, private sector credit grew by 17.6% in June 2024, relative to the 16.1% recorded in the same comparative period of 2023. In real terms, a contraction in CD credit to the private sector moderated at 4.2% compared to a contraction of 18.5% recorded in June 2023. Interest rate trends were broadly mixed at the short end of the market. The 91-day and 182-day Treasury bills rates increased to 24.9% and 26.84% respectively in June 2024, from 21.7% and 24.58% in June 2023. In contrast, rates on the 364-day instrument decreased to 27.83% from 28.6% over the same comparative period. On the interbank market, the weighted average rate increased, underpinned by the tight monetary policy stance and sustained liquidity withdrawals from the market. The rate increased to 28.83% in June 2024 from 26% in June 2023. Over the same period, however, average lending rates of banks declined marginally to 31.1% from 31.15%. The banking sector performance in the first half of the year points to continued recovery from the impact of the domestic debt exchange program. Total banking sector assets grew by 33.3% to 323.1 billion Ghana cedis at the end of June 2024, relative to 21.2% growth at the end of June 2023. Profitability, liquidity, and efficiency indicators all improved over the period. The capital adequacy ratio adjusted for reliefs remained unchanged at 14.3% between June 2023 and June 2024. Without relief, the CAR was reported at 10.6% in June 2024, higher than 7.4% recorded in June 2023. Despite improvements in the banking sector's performance, elevated credit risk poses a threat to the sector's recovery process. The industry's NPL ratio was 24.1% in June 2024, up from 18.7% in June 2023. The consistent rebound in profits, adherence to capitalization plans, and enforcement of strict credit underwriting standards will help ensure that the banks remain on the path to full recovery and resilience. Prices of Ghana's major export commodities traded mixed on the international market. Cocoa price futures bounced back after declining by 19.2% in May 2024 to $9,022.6 per ton, representing 1.1% growth in June 2024. Crude oil prices remained broadly stable in June 2024, with an average price of $83 per barrel. Spot gold prices, however, dropped marginally by 1.1% to close at an average price of $2,325.3 per fine ounce in June 2024. The trade balance improved in the first half of the year, driven by higher exports relative to imports. The trade surplus improved to $1.81 billion in the first half of the year, compared to a surplus of $1.6 billion recorded in the corresponding period of 2023. Total exports increased by $1 billion to $9.23 billion, while imports rose by $884.5 million to $7.42 billion. The increase in total exports was largely on the back of strong growth in gold and crude oil exports. In the first half of the year, the value of gold exports increased by 46.4% to $5.04 billion, while earnings from crude oil exports increased to $2 billion from $1.7 billion in the same period last year. In contrast, cocoa exports, both beans and products, declined by 47.4% to $760 million in the first half of 2024, from $1.45 billion in the first half of 2023. Other exports, including non-traditional exports, also declined by 8.7% to $1.5 billion over the same comparative period. Total import bill also increased, driven by both oil and non-oil imports. Oil imports increased by 6.1% to $2.3 billion, while non-oil imports increased by 17.2% to $5.1 billion. Consequently, the total import bill rose by 13.5% to $7.42 billion in the first half of the year. The current and capital account improved over the period, supported by higher external inflows and lower outflows. The improved trade surplus, alongside higher remittance flows, resulted in a higher current account surplus of $1.28 billion in the first half of the year, compared to a surplus of $863 million in the same period in 2023. The capital and financial account reduced from a net outflow of 1.04 billion in 2023 to a lower net outflow of 367.5 million US dollars in 2024 due to higher government loan disbursements, reduced amortizations, and significantly lower portfolio outflows. Other capital flows, including private capital, recorded a net outflow of 1.6 billion US dollars from an outflow of 1.1 billion US dollars over the same period in 2023. These developments in the external sector resulted in an improved balance of payments position. The current account surplus, together with the reduced capital outflows, resulted in an overall balance of payments surplus of 942.3 million US dollars in the first half of 2024, compared to a deficit of 341 million US dollars in the same period in 2023. There was a significant build-up in international reserves during the first 6 months of the year. Gross international reserves increased by 947 million US dollars to 6.87 billion US dollars at the end of June 2024, equivalent to 3.1 months of import cover. Net international reserves also increased by 1.31 billion to 4.50 billion US dollars at the end of June 2024. The higher build-up in gross international reserves was aided by the strong performance of the domestic gold purchase program. The Ghana cedi came under pressure in the first half of the year, especially in May 2024, but has since eased. The relative stability on the foreign exchange market in the past few weeks reflects the continued tight monetary policy stance, the implementation of the dynamic cash reserve ratio to mop up excess liquidity in the economy, the revised regulations on advance payments for imports by the bank, and positive sentiments from the third tranche of the IMF extended credit facility, and the agreement in principle with external creditors. From the beginning of the year to 19 July 2024, the Ghana cedi depreciated by 19.6% against the US dollar, compared with 22.1% for the same period last year. Summary and outlook. Global economic activity generally surprised on the upside in many countries in the first quarter of 2024. IMF growth estimates for the advanced economies show that growth is expected to remain stable. Growth moderation in the United States is expected to be offset by a modest pickup in the euro area in 2024, driven by stronger momentum in services and higher than expected net exports. For emerging market and developing economies, growth is projected at 4.3% in both 2024 and 2025, driven largely by strong economic activity in Asia. However, persistence in services inflation tied to wage growth could result in central banks keeping rates higher for longer and weigh on growth prospects. On the domestic scene, GDP growth outturn for the first quarter of 2024 was stronger than expected. Economic activity remained resilient in the context of generally tight policy stance. This is shown by the latest GDP data released by the Ghana Statistical Service and the subsequent upward revision of growth estimates. Similarly, high-frequency indicators of economic activity, which are more recent, suggest stronger growth outcomes. Consumer and business confidence sentiment softened, driven by the rapid exchange rate depreciation observed in May and high food prices in June 2024. As the exchange rate stabilizes and macroeconomic stability takes hold, the reversal of these sentiments will further help support economic activity. Reserve buildup has been strong in the first half of the year. The external payment positions improved in the first half of the year. The current account surplus significantly improved, aided by strong gold exports, robust remittances, and the effect of the debt suspension. This development, along with the domestic gold purchase program, helped accumulate reserves faster than envisaged under the IMF-supported program. With a favorable external position and a strong reserve buildup, the Bank of Ghana is better positioned to provide cushion against external shocks to the economy and thereby provide stability in the foreign exchange market. Fiscal policy implementation so far has been on track and aligned with the program. Staying on the course of fiscal consolidation path for the rest of the year should lock in stability in the overall macroeconomic conditions. On price developments, there is some uncertainty regarding the inflation path for the year, given the recent exchange rate pressures, upward adjustment in utility tariffs, and increases in export fuel prices. The above developments have resulted in a slightly elevated inflation profile for the year. Even though inflation is expected to remain within the target year band, the risks are tilted slightly on the upside. This will require maintaining the strong monetary policy stance, supported by strong fiscal consolidation efforts, including remaining vigilant to ensure that the end-year inflation objectives are achieved. Given these considerations, the committee decided to maintain the policy rate at 29%.